All right, let's go ahead and get started. Good evening, guys. Thanks for your patience. This is Ken at Tortoise Capital with the Nightly Strategy Podcast for September 22nd, 2020. Happy fall. All right, let's start with the market health check. So yesterday, Monday, was a big day. It featured a big gap down, that harsh sell-off all the way to Z2, or to Z3, excuse me, within spitting distance of long-term fair value. Made a new 30-day and a 10-day low, and then rebounded in the afternoon to close strongly, all the way back to Z2 at 326. So that was quite a rocket sled move. Today opened up with a fractional gap up, sold off, came back down to the Z2, and now found support and closed strongly, halfway up the stack between Z2 and Z1, basically to close where it had closed 2 days ago and erasing all of this negative feelings. Come on. All right, so let's take a look at the resistance levels. So if we take a look at our dragon here, we see it has gone from sloping down to just starting to flatten out a little bit here. So if we can get some price action like this now, so if this price starts moving along in here, that dragon is going to continue to move along sideways. So this 335 feels like the spine of the dragon feels like an important price level. So we're looking at the combination of Z1 at 333, Z1, the baby dragon, the spine, the bottom of the dragon skin. As we move from the RL10 true price, we'd have to get through the dragon skin in Z1. The dragon spine feels important here at 335. The upper skin of the dragon at almost 337. So that's like 3 layers, 1, 2, 3 scoops it has to get through of resistance from 330 to about 337 is $7, which is about 2.2%, which is about 1 times ATR. So we have about 1 solid directional day that will get us through the dragon, and which gives us the belief that this could be an up, 2 legs down. And then if it can get out of this, then that negates that leg down, and then we're back into this level. So this is kind of the trading range right now, from 337.5-ish to about 326. So that whole range is about, call it $10. All right, so we've got two other layers of um, of resistance we have to get through. So the first one is this RL30, which peaked here, came back down through the dragon, back into the river right here. So this is really, that is the end of trending behavior. When the RL30 crosses back inside the river. So if we look, we'd have to go way back to find when the RL30 came out of the river, and then that makes all of this positive trend. And then after it peaks, but before it ends, this is a weakening trend. That's the first alert that the trend is ending, is that time frame right in here. Of course, we could see that by inspection. And you can see the attempt at recovery off of Z1, but which failed right here at the Bollinger Band mean, then gives us this big move down here through Z1, Z2, Z3, and now we're back up to Z1 and Z2, and then halfway to Z3. So we have to get through that piece. And then we have to get through the dragon. And that really gives us the, so the RL30 crossing the 30 simple moving average, that is another important checkpoint in the life of the 30 period regression line. So one of them is when it peaks, another one is when it comes inside the river, another one is when it crosses the Bollinger Band mean, and comes down to the dark side. So this is this line here is a projection of that RL30, and we're watching to see what it does with this Z1 line. So if it were to fall out of the southern edge of the river, let's say I would project that to happen out here in about 1, 2, 3, 4 days. So we've got about 4 days for this price action to reverse and go higher and to start turning that RL30 around. But if it doesn't get out of there, like if it just reverses and goes back down, then in about 4 days, we're going to have a confirmation of a downtrend. So we can make that claim. That's the beginning of a downtrend in about 4 days when the RL30 leaves the river to the south side. So that's the nature of the fight that we're in right now, is to characterize this transitional state. Okay. Noticing that the Microsoft Ink gets kind of unresponsive when you load up a lot of sketches on it, but it's handy in so many ways that all right. So we've got the Bollinger Band rolling over. We have the RL30 sloping downward, so that becomes an important barrier to get through. The the Bollinger Band mean will start rolling over like this, so that's going to cross somewhere around here. Then the PSAR, which here's our little PSAR dots, and we can project that down this line. So here's tomorrow's PSAR value at about 341. So it has to get through the dragon. It has to close the distance to Z1, has to get through the dragon. Then it has to get to the Bollinger Band mean. Then it has to get through the PSAR. So those resistances are stacked up. If it maintains this price slope, we would expect that to be in about 1-2 days. It'll test the RL30. 3 or 4 days, it'll test the Bollinger Band mean and the PSAR. And then if it can get to this side of that PSAR line, then it feels like it could actually be an up, down, up, and then break out and go. So it has to get above this PSAR, this whole region of noise. That's the fog of war right there. That is the uncertainty principle. What's it going to do when it hits that resistance? Because for 2 days, the panic of the big sell-off has been averted momentarily. You had an intraday turn and go. You had basically a follow-through day. So that's two days of positive momentum. And that's a pretty nice counter trend rally right now, because we're in the winter, and you've had 2 days where people got paid on this side, and it was led by tech both days. So those guys have already made their double scoops of money on the momentum trade. And now the question is, what's going to be strong enough to get us another complete leg up through the middle of this? Is it tech? The question, is it tech, or is it the next sector? So we saw last week that XLB and XLE, energy and basic materials, had both been very strong. But the last 2 days, they both got smashed. So is tech strong enough to get us through that fog? And if not, what's the next sector? Is it XLF? Is it XLB going to now rebound after the 2 days of getting slaughtered? That's hard to say. But we'll be watching, as always, we're going to watch those sectors of XLB, materials, E for energy, F for finance, and see which one of those. Tech is kind of a clear winner already, but we've been noticing these three sectors are doing the cycling that adds the extra juice to tech to get these moves up. So that's what we're going to be watching. We'll see that today materials had the second harsh day in a row, so did energy. Okay. So, skin of the dragon, spine of the dragon, upper skin of the dragon. This includes Z1. There's another one right here. This peak of the RL10 is basically the same as the upper skin of the dragon. So when you add those two together, that's going to make this little support level here. Call that 337. 337 in the S&P is going to be really crucial, because it's going to get above the hump of the RL10. It's going to break out of the dragon. It's going to get past the RL30. And it can get there in 1 ATR. So if we get one strong directional day, we can take out all of that stuff. However, failure to do that, failure to get out of the dragon, now sets up a pocket short, and you want to be short before it breaks below Z2. And so that looks like 326. So this is an area that on weakness in the market, you're looking to be short, so that if it does break through today's low, you're already one short, and then you add a second one here. So that if it then breaks through that 30-day low in the former Z3, that's where you can add, God dang it, come on. That's where you can add your third position. Yeah. So if this rolls over, this creates a pocket. That's where you want to be getting short one before it breaks that low, so that you can have two positions short here, so that you can add your third position if it breaks below the 30-day and the 10-day low, which is also the fair value. So call that 320. That's going to be crucial. So 327 is important. 333 is important. This nice cluster. Those are your kind of regions for big moves. And then again to the upside, it's this one, and then if we can get above there, off we go. So this whole region is the uncertainty zone. Okay. 10-day high at 343. That's going to be the 10-day high for a while. Z1, Z2, Z3. Here's the peak of the RL10. There's the peak of the dragon. So there's plenty of time to worry about those. It has to get through this. It has to get through this cluster right here. And you can see what that looks like if you just take a look at this. If you take a look at this price action, that was the indecision. Was it going to rebound or was it going to fail? And it took, 6 to 7 days of effort to determine, nope, it's going to fail. So I'm kind of looking at this price right here as being the same indicator as that one. Because this was the scary day. This was the first effort at recovery. So if that fails, yes, today's low is the trigger to have your second position short by then. I think you can get the first one on weakness intraday. Then if it breaks below the low, then you go. Okay. So that's my read on this. This is an uncertain market, and you'll notice that we've at one point we were almost 15% above the 200-day moving average. That the stretch was like plus 15, and now it has pulled back far enough that it's now down to like about I think about 5%. So it's given back 2/3 of those outsized gains, and there's just barely holding on right now. Okay, so that's what that looks like. All right, let's take a look at the sectors. Yeah, XLY, consumer discretionary, is a possibility. It has not been as volatile as the other ones, and it's been sort of when it rises, it's because tech is rising and Amazon's part of that, but it hasn't really been a leader. It seems like those other three sectors, B, E, and F, have been more of the directional leaders. When they've been up, they've been large, and when they're down, they've been large. So that cycling back and forth in there has been much more noticeable. I would say it that way. And here's what I mean by that. So if the market is neutral, XLB and E and F have been very directionally strong compared to the S&P, whereas XLV has been more, healthcare, XLV, and then consumer discretionary, XLY. Both of those have been, minor chords. So even when there's outperformance, it's not really as much that gives you the really massive moves that you're getting from B, E, and F. And so then what we're looking at is if you normalize this for the S&P, there are times when B is up and then cycles down, while, come on, whereas F might do something like this. It's kind of inversely. So if you can get those when they're breaking out in the summer and making moves, and then capture that move when it goes into the fall, and then recycle that money down to when F is making the turn from winter into spring, then you can ride that to here and stop. So now you get this B, F, and E, each going at their own pace. And so what you're trying to do is capture these outsized swings and sector cycling between those big broad sectors. Meanwhile, tech has just been, massively good, and its little sector swings have been more like this, where it has consistently been a strong upward channel. And so by default, I look to tech to continue to be the leader, because there you got, you got your key leaders. What am I missing? Oh yeah, I got Apple, Twitter, yeah, Facebook. So all of these guys that everybody wants to own, all the cloud computing guys are leading to that upward push in tech. But meanwhile, you've got these great big sectors that are oscillating. So let's take a look at what we got here. Okay, so for the 4 U.S. indexes, we got the S&P led the way at 1%. The Russell was next at 0.77, diamonds at 0.5, and treasuries basically flat. So it was the broad index, speculative, and the conservative large caps. Looking to the upside, the sectors that were better, wheat and precious metals was basically the same at 1.03. The FANGs, Facebook, Apple, Amazon, Netflix, Google, up 1.5, so 50% more. Tech and discretionary, 1.6 and 2.1. The triple techs up 5 and 5.5%. And then the key leaders, Twitter and Amazon. So Twitter just feels like it's agile enough to really be leading the way. I don't think it hasn't exploded into its full glory yet, like Amazon, Google, Tesla have. So that's why it's been a favorite of mine. And now it's back up to 42.73. That's actually pretty cool. Amazon, big one today, 5.6. Nikola Motors, that's always a real speculative one. I don't really treat that as a tech company. That's just that's gambling. Facebook, Microsoft, Google in solid conditions here around 2.5 and better than the tech sector at 1.5. Apple, rounds out, the key tech leaders that were better than the market. Joined by, what do we see? And Win, Speculator, Caterpillar, and Salesforce. So really, on our stack anyway, it's just those massive tech leaders today and very little else. Lagging a little bit, still in the green, but lagging the market: NVIDIA, Walmart, Cisco, Intel, Simon Property, Home Depot. So these were, although in the green, not as convincing because they were even lagging the market. All right. So to the downside, S&P +1, then you have Japan 0.3, materials 0.2, so lagging a little bit. Healthcare and clean energy -0.2, oil -0.4, emerging markets -7.75. A big cluster in here in the energy finance cluster. Oil exploration -0.8, finance -0.85, Brazil 0.85, energy -1, silver -1, Ackman -1, Mexico -1. So a much broader array of weakness, except for those big tech leaders. So I don't really see any other sector really pushing to lead the way. Now, among the losing companies, U.S. Steel, I'm going to show that one here in a minute, -6.5, Tesla -5.6, Cliff and Goldman -1.8 and 1.3, Devon Energy -0.7, Alcoa -0.7, Nucor -0.2. So all of those metals lagging XLB. So that's why it feels to me like that this 2-day bounce is really just kind of a tactical bounce, if I can say it that way. Because what I'm seeing from today's little price action is that those 2 days worth of gains was really just big tech that was responding to a negative Z3 excursion. But you look at all the other supporting players, materials, finance, energy, healthcare, discretionary, all of these things lagged that. And so as this gets narrower and narrower, if tech has any hesitation, then this thing rolls over pretty quickly. And then the downward weakness that we've seen in these non-tech players takes over. And so that's why, to me, this skin of this body of the dragon and this downward sloping RL30 and the PSAR just act as such a strong resistance that tech has already had 2 days of big recoveries. Is there another 2 big days left in there? I don't know. We'll see. So I'm prepared in this critical state. I see this as a critical state because we had the big move up, down, short rebound, big sell off, and now we've bounced to here. So now, are we going to get this move back to here, or is this move going to fail? And then if it breaks below this swing low, which is 2 days ago that low, which is the 30-day low, then that thing collapses big time. So this is that pocket. This is the collapsing dragon line right in here. 322-ish, 321. So yeah, so the upside is possible for sure. And then it has to get through this, all of this crap here and basically get beyond the PSAR. If it gets beyond the PSAR, then it can go. Until then, not buying it. So I'm still staying very tactical, day by day, no overnight risk. I'm just mindful of that 10-day and 30-day low. So I want to talk about U.S. Steel here, just as it's the opposite of what you would think of as a groovy tradable vehicle. It's not a small cap. It's not a tech darling. It's a doggone steel company, for crying out loud. And yet, if we just step back and look at this thing, this is on a 15-minute chart, just so we can slow down. So what's a 15-minute chart? Well, 1 minute, 3 minute, 5 minute, 10 minute, 15, 30, 60 minutes. Clearly this is pure day. And so I see these things in here as really slow day or very fast swing. So it has this hybrid quality. And so if I'm bringing swing trade patterns in and I want to do some turbo on them, well, instead of using daily charts, I can come in and pick one of these time frames and then accelerate the swing with tighter stops, more frequent decisions. I can start piling on to positions earlier down here like this on that intraday, on the 15th, between here and here. There were some opportunities, even on 15-minute charts, to get paid. And then to be flat going into the overnight session. And the next day when it continues, there's a chance to resume and get some of this. And then miss all of this gap. So I can start playing swing trading one day at a time, even using something as very slow 15-minute charts. If I'm a day trader, I feel like, 15 minutes is really slow. But if I'm an end-of-day trader, 15 minutes feels really fast. Well, is it fast or is it slow? Well, that really has nothing to do with the time frame. That just tells you the cycle time. It really is compared to what you're used to or what your comfort zone is. So it can be either one of those, and that's why it's a nice hybrid time frame. So what I want to show is that starting the 17th and the 18th, there was a 2-day period in here in which you had XLB double plus good. Hooray. And then inside XLB, US Steel was even better. So you had the strength of XLB plus the strength of US Steel, and this is what you could end up getting. So if you're getting this supported spring crossing or a breakout from the previous high, supported fall crossing, even here as you get the rising VWAP, you end up getting this entry in here at about 782. And if you're using the PSAR as your risk, that's at about 762. So that's a 20-cent risk. And that first day, you get this double plus goodness. And if you want it to be flat before the close, you're looking at about, let's call it 832. So 782 to 832 is 50 cents on a 20-cent risk, 2.5 execution R, and that's not even counting if you take a second position here. Now, if you take a look at that as the first day of a big sector and a big company move, you might be saying, that's interesting. Do I want to core plus turbo that? If you do, you might take whatever the size you had intraday. And so let's say you were risking $400 and you had 20 cents of intraday execution risk. You could have as much as 2,000 shares. If you then just take 1/5 of that, you say, let me hold 400 shares overnight. with a full dollar of risk, and a dollar is this size of a risk. That would have put your stop well down here below fair value. So if you were holding, if you essentially you're deciding to buy a position here at 850 with a stop at 750, which is below um, the morning's VWAP where it opens. So that actually feels like a pretty safe bet. And then that thing gaps up, and then you get another move intraday from 875 to 950, and that's 75 cents. So if you're using something like a standard 20-cent risk, there's a potential for 3 execution risks just inside here, and with a logical exit when it comes back through the dragon and crosses the VWAP. And so everything rolls over. Notice that you've got, at that point, the RL10 and Baby Dragon roll over very close to Z3. You got a PSAR flip. The dragon has rolled over. You've crossed the VWAP. It's like, dude, okay, I get it. I'm not supposed to be in that trade anymore. I understand. When it crosses the Bollinger Band mean, you might have been tempted to go short, but it's so close to the end of the day, you probably wouldn't. Why would you? Because at that point, it still feels like a really strong move. And you've had these 2 days in a row of goodness. But after 2 days of goodness, and it rolled over and closed weekly, that feels like this, and that run is done, and it's coming back to the long-term normal, right? So you just wait for the next day, gaps down, leaves Z2. So there's Z1, there's Z2. Get short when it crosses the VWAP. Get a second one short when it breaks through the long-term fair value. Here's the RL270. And there's the Z3 line. So go ahead, put a second one on. The short side is always easier, and you think it's coming back to here anyway, because this is where the previous VWAP was. And notice that's where we had put the little resistance bar. So when it breaks now through that one, you can add a third position the next day. Even if this gets you out, not unreasonable, you get paid in here on 2 positions. And then the next day, it starts breaking down below the collapsing dragon, or you wait for it to get below the PSAR. You get 1 or 2 positions in there. So what I want to show here is that after 4 days, so you've got 1 day of grinding up, a second day of grinding up, both of which were tradable on the 15 minutes. Then you got a nice big day up, a second big day up, but then a sell-off. And then you have 1 day down, and today 2 days down, and you are right back to where you started. But if you can be non-directionally biased, you notice, hey, this is how far that XLB can stretch, and the U.S. steel. It went from, call it 740 to about 940. That's plus $2. $2 on 7.5. 2/7 is, that's about a 25% gain, on the base price, up and then down. Now, if that should really get your attention as the kind of a target that is really tradable in this time frame. You have something like we might say if fair value was somewhere around $7.50 a share, that underneath that price is the real value, long-term value of a steel company. I mean, that's people and jobs and infrastructure and inventory and future sales and industrial America. I mean, that thing is not worth zero. It's worth something. And then this little speculative piece up here to 950 is a $2 range, a 25% volatility range where you're getting this kind of action, and you're getting something like some kind of core fair value. Now, I don't know. I haven't done any math on that. I can't say. But in terms of interpreting this price action, that's exactly what this feels like. This feels like a bunch of guys come in and juice the price and then take advantage of the momentum play and are just more than how many days do you want to have a 4-day sequence where it goes up 25% and comes down 25%? How many 4 days in a row like that do you want to have? Forever? Yeah, sure you would. So could you be a specialist in U.S. steel? Sure, why not? So for me, as I start looking at XLB as one of the key sectors of SPY, and I look at U.S. steel as a key member of XLB, I can also compare him to Nucor and Cliff and somewhat derivatively Alcoa as the metals. And that's my little metals gang. And so I just harvest these things all the time. It's like the running of the bulls. First they go here, then they go there, then they go here, then they go there. And then there's some seasonality component of XLB, and I can just watch those four and see, of those four key components of XLB, which one is doing the moving lately? And then as long as I'm watching the relative ups and downs of the S&P, and then the cycling of XLB around that, and then watching those, that little synergy between those sectors gives me that logic chain for XLB. You guys have heard me say this 1,000 times, so here's 1,001. So if S&P is my drummer here in the middle, and this is XLB, and those are my four little horsemen there, X, Nucor, Alcoa, and Cliff. Finance, tech, energy, Devon Energy, oil exploration, Goldman Sachs, JP Morgan, and heck, you can really just use FAS and FAZ and just play the sector directly at a 3 times, because these things are as liquid as can be. That's all the banks trading around their own positions, I think. And then tech, I've already shown you, half a dozen things, because as long as this one is the real leadership, you can take a look at old school tech like Apple, Microsoft, Intel, Cisco, that whole crew, or look at the new guys, Facebook, Google. I almost want to throw Tesla in there, Amazon. I would throw Twitter in there too. So and then among tech, so is it old tech, new tech? Old tech is kind of like that TECL, that's that 3 times broad tech sector. And then TQs, the triple Q, is this whole gang, because this thing is top weighted. So you get a few more choices on tech. But what I want to do is I want to show this now as a relationship diagram between SPY, XLB, XLF, energy, XLK. Now, I'm only showing 4 of those 10 sectors of the S&P. And the reason I do that is because those feel like the ones, and those are the ones that have the greatest divergence from the S&P in terms of that volatility. So like XLI, the industrials, they kind of track XLB a lot, and it just feels like XLB is a little more volatile, so I don't put them in there. XLU is so boring that I think I can get that in treasuries anyway. And XLP, I forget what that is. XLV and XLY, they just don't seem to be as, and XLC, the new telecom one, those just don't have the same strength of variation that those four bellwethers do. And then you really do have separation between these two. Like tech moves according to its own beast, and banks move according to their own beast, and energy moves according to, oil and politics, and basic materials just feels like it's different enough from those three that you get, just with those four and the S&P, you get a legitimate way to manage sector cycling inside the U.S. altogether. And you could throw in, if you want, IWM and DIA to see, is there a U.S. index? Is it the small speculatives? Is it the big fat broad index versus the granddaddy? Which one of those seems to have the juice? And then you can also say, well, let me see how SPY is doing, the U.S. against EFA, the mature world that's not the U.S. So there's a real distinction. And I could even say EWZ and EWW as not the U.S., not the globals in Asia, but its own little region, and two very good frog champions. So just in those symbols right there, that's 15 symbols. When you throw in TLT, that's 15 symbols that you always have something going on in the world. So if that's your core 15 on your ETFs and markets, then you have some peripheral ones around here which add, like these other companies that you could specialize in. So an inner ring of 15 and an outer ring of another 15 or 20. So for about maybe 30 symbols, you've got an all-weather herd that you can just watch them going through their little cycles of up and down, and the market's up and down. And depending on which part of the curve is for you, I like this one from spring into fall. And I like fall collapsing into winter. So that's my first and second priorities. Actually, first part, I love the collapsing dragon. So you decide which part of the curve is yours. Then all you got to do is have a herd that gives you enough opportunities to be able to take advantage of these oscillations. So all you're doing is riding the waves that are caused by big money moving in and out according to their own algorithms and their own tactical plays, And that is the essence of a statistically informed hybrid trading, swing trading one day at a time. So if each day now I'm looking at those swing trade patterns, and it's so that I can just understand where things are in their swing cycles, and then use turbo to get more on up days and down days with these other smaller companies. But each day is just its own thing. And I'm not carrying a lot of positions overnight just because the market condition right now is so darn fragile. For the next 50 days, until 5 November. Man, that's crazy. It is just crazy. There's so many shenanigans out there that I don't trust any of these longer term moves, with the exception of tech, because you got to own the future at some point. And probably energy, because I think you got to keep the lights on. So there's something fundamental about that. But everything else is now statistically informed hybrid trading. So I think you got to, Dave, listen to the in that 37 strategy series that I'm doing, did number 12 this weekend that talked about descriptive statistics versus inferential statistics. And that's an important distinction, and that's one that I would listen to repeatedly, so you get an appreciation for how statistics is your adaptive guide through this whole series. Let's see. Dominic asked me about gold. For me, gold itself is still kind of narrowly traded, and it gets pushed around so much by the contract that if you're trying to use the gold ETFs, you're trading in between the bid and the ask on the gold. It's even more pronounced in silver. But I would say that I think you have seen me use, if I was going to add one more to this list, so if we said the S&P and you had materials, finance, energy, and tech, yeah, I might put, you could say, yeah, well, gold and silver as the defensive plays. I just abstract that into wheat and precious metals because they are a precious metals miner and commodity manager. And so you get all of that favorable volatility and defensive plays that come out of the gold and silver itself, but you also get some company volatility based on their stock performance. And so this is wheat and precious is like a leveraged precious metals ETF in that sense, that it has all of the characteristics that I want, that it can benefit as a defensive play, but it has enough volatility that I can do turbo trading and tons of volume and very narrow bid ask. And whereas if you watch silver, like if you're trying to trade SLV, it'll go for minutes and almost hours without making a move, and then it spikes and gives you this price. So you get a very disruptive, non-continuous price. You don't get that smooth price at all. But Wheaton is so liquid that you would see Wheaton being traded continuously all the way up and all the way down, and it actually goes more up and more down than gold and silver, because gold is actually not that volatile when you compare it to S&P. It's actually less volatile than market. So I need the extra volatility of Wheaton, plus it gives me the benefit of gold, silver, precious metals. And so I treat it as a special case, almost as if it were a precious metals sector fund. But it's really just a company fund. So I'm playing in that gray area and using wheat and precious metals for that reason. Okay. So that's what I want to say about that. Does that answer your question, Dominic? Okay, so in conclusion, I just want to draw this attention that from here to here, it was basically flat, but it made this move. And here is something like that long-term base of safety, and maybe this is the tradable range from 7.5 to 9.5 and a couple legs. Notice these intermediate steps. So you got 1, 2, 3, 4. Lather, rinse, and repeat. Okay, so let's shift to the daily report review. Okay, September 22nd. Come on, dummy. September 22nd. So we've already seen the health check in painful detail. Let me know if you in the chat if you found that the market discussion helpful, and then the that little impromptu sector cycling and whatnot. I don't know if they found it helpful. I mean, I spend more time probably on that market assessment now than ordinarily, just because of the importance of the market as the primary direction finder during chaotic times. God dang it. In the interval from I looked at it and it printed it, it gave me an error message in here. Well, I'm not going to worry about that because it's the market classification, the market condition. So we're in this critical state where it can go big down or big up. I'm betting on the big down. I'm leaning that way, I should say. I'm not actually betting on it. I'm waiting to see, but I would be less surprised by that. You got a couple of channelings and overreactions in the globals. Our ATR percentage is 2.4 now, so that's 3 times as volatile as it was 2 weeks ago. Risk Z slowly improving, as we can see here. Tons of auto framers, as you would expect. Lot more dojis than you might expect on a kind of a upward driving day like today. So that upward move was more a function of big moves in tech and move of the index, but a lot of the other companies that didn't follow through actually had quiet days. Microsoft, Nike, and Amgen. Microsoft to me is kind of a hidden gem. Not so hidden. Lots of 5-1Ws today. So just again, a quick review on the 5-5-1W pattern that's worth highlighting. It's like a lazy man's triple screen or buy on dip. Five 5-1W. A relaxed form of the triple screen. So you'll actually see a couple triple screens in here as well. So Caterpillar is both triple screen and 5-5-1W, as is Verizon, as is Salesforce. So the triple screen said you need a strong weekly trend up, and then on a daily chart, on a daily, it pulls back below the 20 SMA. In the Alexander Elder version of this, you then would drill down to an hourly chart, and then if it opens and there's the first hour, and then you get an hourly breakout, well, then you just buy that. So strong on a weekly, pull back on a daily, and then the hourly is starting to show a reversion to the primary trend, the weekly trend. And so I set that as a target at like the 10-day high. So that's the triple screen, as I interpret Alexander Elder. All praise to the old guy. Good stuff. So the 5-5-1W is a relaxed form of that. We still want this kind of basic pattern. And so the way I relax that is that the first 5 is that wherever, so if this is today, if that's the 0 day, and we go back 5 weeks or 25 days, we find whatever the price was, and today's price is greater than it was 25 days ago. So price higher than it was 5 weeks ago. 5 days ago, so if this is the 0 day, we go 1, 2, 3, 4, 5. Read up, and we say, so the price 5 days ago was higher than the price today. All right. And that gives us the measured pullback, that the net of the last 5 days, however it got here, is lower. So that's the pullback. And then 1 day of gain, meaning that the close was higher than the open. So this is a white candle on the 0 day, on the setup day. So you had price. So today had to be a white candle. So today price is greater than it was 25 days ago. It's lower than it was 5 days ago. And today was a white candle. So you get an up, down, and up. And then finally, the Williams percent R, as I relax the criteria and I just say, hey, if we look at the 10-period trading range, it had to be in the bottom half, meaning that you had more to the upside than the downside. So 551W is what you get. So here's Caterpillar and Verizon and CRM, Salesforce, with 551Ws. Kind of like American Express here. It's 2.5 to 1. It's a 551W. Caterpillar is nice. It's a TS and a 551W, and it's 2.8. So that's pretty cool. I noticed that JP Morgan was a 5-day down, and Travelers is a 5-day down. So that's really weakness in XLF. And so that 5-day down, all that requires is, from -5, 4, 3, 2, 1. Here's where it closed. Lower close, lower close, lower close, lower close, and 0 days. So 1, 2, 3, 4, 5. So if you get five lower closes, you get that 5 days down. And then we just frame that 5 cents above and below. We play for a return to wherever the 10-day high is. And we look at the range risk. So we take the distance to the 10-day high divided by the range risk, and that gives us reward to risk ratio. So you can see, like on this 5-day down in JP Morgan, it's 3.7 to 1. So whatever JP Morgan's, it was probably down today. I think it was. Yeah, it was minus 2.1% in JP Morgan, so it was a red candle day. So if it reverses tomorrow and takes out yesterday's high with 5 cents, we might say, oh, this is some actual evidence that those 5 days down may have been an overreaction. And it's 3.7 of these ranges back to the 10-day high. So I don't know it's going to do all of that, but I can at least get well started, and I might be able to turbo just that first day. And if it keeps working, I might get the second day, and I might get the third day of momentum. But I'm really, at times like this, just looking for the intraday reverse of direction move. So 5DD turns out to be a nice way to consider swing trading 1 day at a time. This is turning into the workshop here, So 551W, triple screen, 5-day down. Good standards. It's like, going to a concert and listening to your favorite songs. Where is my mouse? There he is. Okay. In the ETFs, a ton of dojis, a nice selection of channeling is an overreactions, not surprising. Almost everything on a auto framer of value. There's silver, 4 to 1. The Dow or UDow 3-1. Materials is a 551W and 4.6-1. Need I say more? You can be certain I'll be interested in that one. There were no breakdowns or breakouts today when I look at the NDX real quick. See a ton of things that have single digit on the RSI2. That's a real short-term extreme. RSI2 is a real short-term extreme. And anything less than 10 or less gets highlighted to alert me that the only way you get a single-digit RSI2 is that you had to have 2 solid days of selling in a row, and still quite a lot of things had that. And notice that this little cluster in here, none of those are techs. Those are all just broad indexes. But you notice that tech, which has been very strong, XLK, has an RSI2 value of 75. So you can see where the strength is just of the last couple of days just by monitoring that RSI2 column. Look, there's a 62 right there in treasuries. So treasuries have been pretty solid. And the Qs, QQQ has been solid at 76. So this tells you where the real strength has been. There's a 60 in discretionary, and that's based on the strength in, I'm sure, in Amazon, right? So there you are. That's how you do that. There's all sorts of things in there. You can observe a lot just by watching. The auto framer is going to always find a lot of things that test out well when the entire market is sold off. So I would be, this is one of those times that I would spend not as much time trying to ferret out each and every little company, but I would really stay with those big sectors in the markets and get that right. And they're going to pull everything else around with it, because most of the variation is coming from guys slinging big money on the indexes. The daily squeezes, these are ones that had relatively small ranges today. Walmart is of interest. Salesforce and Treasuries as like defensive plays. And I always like watching Home Depot. We already knew this. Ton of things in the winter. The 2 days of rebound, though, have brought a lot of leaders back into the spring. There's your techs and healthcare. I should also say the Qs. Just the final one we'll show today, and that is the you got Walmart and Apple had the nice breakouts on the 3-day box, and Procter and Gamble and Microsoft. So those 4 are real clear leaders in terms of relative strength advantage. And then over here, it was just tech today. And then the little bit of XLY coming from Amazon, I think. And then the tech sector pulled the whole market up. But everything else, dude, there's not much there. So those 2 days are a chance for people to protect themselves against what were really horrible losses 2 days ago, I bet. So we'll see what happens tomorrow. But between now and the election, you know, my spirit animal right now is the coyote, just the master opportunist. All right, that's everything I wanted to cover tonight. And let you get about your preparation. Thanks for your kind attention. And back to work we go. Hi ho, hi ho.